Well, my job is kind of simple here. I mean, because this presentation is, there's not much to say other than I find deals and then I just pass them to Todd and he cleans up all the messes that we create on the acquisition side. I mean, it's as simple as that. I mean, that's what it comes down to. But no, and in all honesty, you guys, I think what you'll find today in my presentation, I really am. I'm a pretty simple guy, and I'll expand upon that here in a little bit. And there's a lot of things I'm mediocre at in life. There's just probably a few, maybe less than a handful of things I'm good at. And there's one thing that I feel like I'm great at, and that's finding deals. And so we'll kind of break down the mechanics of what we do in the acquisition side of Sunrise, and I think what really helps us, set ourselves apart from other competitors in the space, because there's no shortage now of mobile home operators out there. There's a shortage of parking investment groups, but mobile home, it's the latest and greatest thing. 15 years ago, that was not the case. 15 years ago, I think I was telling someone last night at dinner that, one of the biggest challenges that's very opposing than what it is today. The biggest challenges back then wasn't necessarily finding deals at a good price. It was actually getting them financed. 15 years ago, banks didn't even understand this niche. I mean, I used to bang my head against the walls, call as many banks in the local geographic region as possible and get, 99% of no's because they didn't understand the niche, they didn't understand the economics behind it and what a great asset class it was. And that was even days when you could buy things at 12 caps, 15 caps. I mean, massive, margins on yield and still challenges to get things financed. So, again, we're going to break down really the discipline behind the acquisition side, what our buy box looks like, again, and just really how we always take maybe sometimes an overly conservative approach. One could probably argue that some things that we pass on, we seemingly could make money on. And I'm going to share an example today of one of those deals that we probably would have made money on. But there was reasons why we passed on it and why we just really stick to our criteria, our buy box. We know that it's worked. It's worked for many decades now. As Bronson had just aged me by saying multiple decades. I've been at this for quite some time. I've got the grays now to finally start showing it. I haven't lost the hair like Brian yet, but I've got the racing stripe is what I call it that goes down the middle. That's natural, by the way. It just happened that way. So with that, let's, I think there's probably a few of you. I mean, I think maybe the majority, do I hit the green button, right? Majority, yeah, look at that gray racing stripe up there. It's nice, huh? I used to trick people. It's funny. We just got these headshots done a couple weeks ago at our annual event. And if you go out on social media, you'll find that there might be some pictures that look like that, but there's this old picture of me that's been floating around for a long time. It's almost a kind of a joke now. It's an old headshot that I got done probably 15 years ago. And I had, it was cool hair back then, but it was like floppy hair. And, I had my suit jacket wasn't as like nice and fitted. And so we've jokingly kind of kept that old headshot around until we just got this to where I'd go to conferences and some folks wouldn't even recognize me. They're like, are you, I think you might be that same person. Like, yeah, that's me. Yeah, anyway. So I've been at this now for 26 years. I was very, very blessed to meet who became my first mentor at the age of 20. Met a guy by the name of David in Harrisburg, Pennsylvania, where I grew up. And at that point in my life, early days on, like when I was 12 years old, I had a paper out, used to shovel snow, mow grass, make money doing that. This is back when you could tell kids to go, get a can of gasoline, start the lawnmower and mow, and it wasn't child abuse. And so I'd go make money doing that. I, learned how to install electronics, car stereos. Back in the day when it was really cool to have loud systems in your car, I taught myself how to install car stereos, and I'd do it for my brother's friends. They were all older, had vehicles, and so kind of just did anything to always make money. And but I didn't know when I graduated high school. I didn't really know. I knew I wanted to do something big. I just didn't know what it was yet. And at the age of 20, I met David through long story of just a girl I was dating. I met him through her, and Dave was a local real estate investor, and he really got me into the business. I ended up working for him for like a year and a half for free, just basically committing my time to understand the craft of what he was doing, how he did it, why he did it, how he said what he said, who he said it to, all those things. And so I did that, from the age of 19 to 20, and I bought that first property at the age of 20, which I was telling someone last night, it was probably in the worst part of town. One of the bigger rehabs I've ever done for the first deal. And I did make money on it, but I learned very quickly of, how to pick the markets, how to pick the neighborhoods, stay away from certain streets, stay away from the wrong side of the tracks. Just because, the deal looks like a great deal on the front end, you could buy it at a low basis, doesn't mean it's a great deal, and it might absolutely crush you. So I did make money on the first one, so I've been doing this a long time. I've been principal, both with personal deals as well as Sunrise, collectively over $1 billion of transactions. Again, I kind of age myself when I say that I've been through 2 real estate cycles now. And so I've had the opportunity to see quite a bit, see what, especially in 08, to see what people did, how they managed through the down times, how they, got back up on the horse or didn't, right? And how they changed their business moving forward. And as I say that I'm a pretty simple guy. I'm a self-proclaimed jewel junkie, but simple in the fact that if you had to break me down into 3 buckets and define me in that manner, first and foremost is my family. My wife, Joanna, my 2 boys, Jackson and Julian. Like, they're the world to me. I love being a husband, love being a father, love everything about family life. The second, if you want to make me really happy, just give me water. Give me a boat. I'm even happier. And a cold beer. And I'm good. Like, you put a big smile on my face. It doesn't have to be much more complex than that. But the third thing is deals. I love deals. And you probably heard Brian say that I've never overpaid for anything in my life. For whatever reason, I don't know what point in my life it got ingrained in me, but there's this running joke in our household. Whenever I bring something home, it could be a pair of shoes, it could be a shirt. I mean, anything I buy, Joanna, my wife, she always says, "Let me guess, you got a deal on it." I sure did, honey. I wouldn't have bought it unless I was getting a deal on it. So, and again, that might be to my detriment sometimes. We might be overly conservative on some things that we buy, but I feel like that discipline has allowed us to sleep really well at night, knowing that our capital's protected, your capital's protected. Over the last couple of years, when I know that some of you guys are involved in deals that are a challenge right now, right? Like where there's been loss of capital, there's been capital calls, and I feel really good knowing that like our portfolio's in a great position. We've got a great capital stack in place. We buy with the margin of safety, and we protect that downside. I mean, we live and breathe that day in, day out. And you also find is when I say I'm a simple guy that Brian and Todd have all these fancy PowerPoints, all these nice transitions and fancy graphics, and mine's pretty basic in nature. But it's okay. Hopefully it gets the point across. Our job in the acquisition side, it's not to say yes. I mean, it's to say no. We do our best to say no 95% of the time. And again, as we talked about yesterday, I figured out a whole system for the other 95% of deals. We're going to pass on Mark Singer. He's going to pay us a fee, and we're going to help you guys juice the returns a little bit. Love you, Mark. Acquisitions, they're really easy. I think all you guys, if you're on Facebook or Instagram or whatever, you just see a lot of folks, and even we do. We always want to champion our wins, right, on the front side of acquisitions. But, that's just a part of it. I mean, championing the acquisition is easy, right? We bought the deal. We got partners to line up. We thought we found a great deal. But really, a lot of the hard work comes in, not just on the buy side, but after the fact with Todd. And like I said, I mean, really, we can do our part to buy what we feel is a great deal, but we've also got to have the operational front in place in order to execute the business plan and get a meaningful return and do our best to hit those projections. I feel as though that underwriting, it really is the last line of defense to protecting the downside, your capital, the downside risk of a deal. That's where it all starts. I mean, everyone knows the old adage of you make the money on the buy, and that's absolutely true. But on the buy side, again, you got the buy side, you got the operational side, but there's another component that a lot of people miss on, and I think it's an area that's got a lot of deals in trouble over the last 4 or 5 years, and that's the capital stack, right? I mean, just understanding the capital side of the business, understanding how to put a durable loan product in place that is going to give you optionality and give you security over the period of time that you intend to hold the deal, right? I think a lot of operators have gotten in trouble the last couple of years because they were a little bit short-sighted there, right? Like thinking that, their crystal ball told them that nothing was going to change, leasing velocity was going to maintain, that the demand for the product was going to maintain, that their rent growth was going to stay in high single or low double digits, and all that changed. And unfortunately, a lot of those inferior capital stacks are the reason that a lot of those deals went sideways or are going sideways at the present time. And so we're really particular about the type of debt that we put in place. Again, probably overly conservative nature, but again, that process and that mentality is what allows us to create a very durable portfolio that has allowed us to continue to pay consecutive distributions quarter after quarter, even when majority of other operators have had to pause or maybe even do capital calls. So, and I think we made comments about this yesterday. I did individually, so did Brian, but there's a lot of truth in this last bullet point here. I mean, we're heavily invested. The majority of our net worth is tied up inside of Sunrise, our personal capital, our family's capital. We've got mothers, fathers, in-laws that are invested in Sunrise. So, I mean, this really is, we're intertwined into this. And so we really do treat every single acquisition as though we're buying it with our own balance sheet, that our own family's lives depend on it, right? Like this is, we've got family members, this is their retirement, and so we don't take this lightly. We don't take your capital lightly. We're very intentional with how we buy, what we buy, where we buy it, and in the business plan behind it. So I think that I don't like these transitions. Sorry, guys. We're just going to get this all out there. So, what does our underwriting look like in actual practice? And I think these are like the areas that I think really separates us from the other buyers in the market. And I know what the other buyers are doing because I know a lot of the other groups in the space. I know what their buying criteria looks like. We're really close with all the major brokerage firms, and so we have really good intel and data on what our competitors are actually doing. And I'm not going to say that what they're doing is wrong. I'm just going to say that what we're doing, I think, is more right. And I think it's a more conservative approach. And I think it's one that will last multiple decades, and it's durable for multiple decades. So, for example, in the exit cap rates, whenever we're underwriting anything, we'll look at both a 5-year and a 10-year model. We like to buy with the intent that we're going to hold it for 10 years. But again, there's never a guarantee there, right? Like things change, business model changes, expectations change. And sometimes, you might want to exit out early. And so we look at both scenarios, both a 10 and a 5-year. But when we underwrite cap rates, the one thing I can promise you, and again, Brian spoke to this, is that my crystal ball doesn't work, yours doesn't work, nobody's works. And so, we have no idea what the future is going to hold. And so we try to take what we feel is a more conservative approach than the other competitors in the marketplace. And I'd say that most of these standards, what you're looking at up here, at least as it relates to exit cap rates, is mostly applied to MH. Parking, we look at slightly differently, and probably even a little bit more conservative on the exit caps. But when we underwrite MH, our exit caps are anywhere between 5.5% to 6.5%. That's really market dependent. If it's a primary market, then it's probably going to be closer to 5.5%. And if it's more of a secondary or maybe even tertiary market, it might be 6.5%, maybe even 7%, depending. And so most of our competitors, they're underwriting for sub-5 caps on exits 5 years down the road. Again, no one knows what the market's going to do. And I'm not going to say they're wrong. I'm just going to say that I feel much more comfortable that I'm going to be right and that this will win in the long run. I just looked at a deal the other day, like a couple days ago, and it's in Florida here, and Florida's hot, and it was a market outside of Orlando, and so Orlando's one of the fastest growing markets inside of Florida, and it's a great market. But the broker's package, this is the broker's package. It had a 5-year model, and it was all built upon a 4.25% exit cap, and that was after stabilization. And I'm not going to say it's not going to sell for that in 5 years, but man, that is tight. If anything goes the wrong direction, you're not making money. Like your returns are going to be very mediocre, if any, at the end of that 5-year span. If exit caps move 100 basis points, it's a big difference. It's a big difference. So again, we're pretty conservative on that front. The leverage point as well. I don't think you can necessarily, what others are doing, I don't think you can necessarily get 70 to 80% leverage in normal loans. And so, but bridge loans, typically you can typically get quite a bit higher leverage. We don't do that. We don't play that game. Our average, I think Mike had presented yesterday, our average portfolio right now, I think the loan to value is like under 50%. But when we're looking at deals, we're typically putting anywhere between 60 to 65% in place. I want to know that we've got that equity buffer in place so that no matter what happens, no matter what plays out in that deal, that we've got a cushion there that can carry us through even the worst of times. Our debt coverage ratio, I'm watching guys that are underwriting today. This is starting coming back into the fray. They're underwriting to a 1.0 or a 1.1 debt coverage ratio. That doesn't leave much room for error. We always underwrite to a 1.25 floor. We only do fixed rate debt. Just no exceptions here. Again, Can't time the market, can't tell you what's going to happen a couple years from now. And again, I think that we all, in one form or fashion or another, we either are personally involved or have seen others that we know involved in deals where adjustable rate debt has absolutely kicked their butt over the last couple of years and made deals that were otherwise probably great deals, struggle. And then, like I said, we always underwrite to a 10-year model, and we look at both 5 and 10-year scenarios. And then I think the last area that I see separates us, maybe not from some of the big players in the market, but a lot of other guys that are getting in, and they always underwrite. A lot of folks underwrite for the front end capex, like some of the stuff that Todd was showing us, road improvements, trees, amenities, things like that. But what they fail to do is underwrite for future reserves. Like literally set aside a budget, underwrite a budget for an annual basis to set aside reserves. Because guess what? I mean, a lot of these parks were built. They were built 30, 40, 50 years ago. So they've got older infrastructure. And I don't care how much you put in, how much lipstick you put on the front side, you better be setting forth a budget on an annual basis to keep those things up, right? Keep the roads up, keep the trees trimmed, refresh amenities because they don't last forever, right? You can put the lipstick on the front, but ultimately that lipstick wears off over a period of time. And so we're always underwriting capital reserves so that we know we've got capital to handle the necessary items as they come about, even years down the road. All right, again, I'm just going to go ahead and get all these out of the way here. I think it's easier. One of my original mentors, I've had a couple amazing mentors. He always really enforced in me that, you can buy great deals, you can operate them well, you can do your thing, you can run the model, but if you get the debt piece wrong, really, the debt is the only thing that can really absolutely sink your ship. It is. And that doesn't even necessarily mean like getting adjustable rate debt versus fixed rate debt. That means over leveraging. That means not really thinking through a plan B and a plan C, like putting shorter term debt in place or getting 2 and 3 year loans, debt that requires rate cap purchases, right? And so debt, if you've put a conservative type of debt in place and one that is going to be fixed for a duration, that's going to carry you typically through even the worst of cycles. And so again, just being very particular about what type of debt we put in place on the front side so that no matter what happens, again, because there's always unknowns, there's always skeletons in the closet of these deals, that we can manage and navigate through those. Again, non-negotiables for us, fixed rate debt, 60-65% LTV. We don't stretch for max proceeds. We don't play that game. We know that we're going to get those proceeds out. We're going to execute the value add plan, and we're going to get those proceeds out when we do a cash out refinance, when we do a capital event. And so we just want to know that we've got that cushion until that point in time so that we can do our thing, run our business plan, and then know that we can tap into the equity at a future date. And then, again, just I think reiterating that we don't try to time the market. We don't mess around with floating rates. It's just not a game. I'm not smart enough to play that game. I feel like, again, your crystal ball better be working quite well if you're going to jump into to that boat. And again, mine's been broken for many, many years. So again, just comparing us to what I see in the marketplace and what we do differently than a lot. And again, this is pretty applicable or mostly applicable to the MH side. We take a fairly ethical approach. Lots of stuff that we're buying, it's got a loss to lease recapture where we're going in, maybe the market rate is $500 and we're buying it at $350 lot rents. So we've got that $150 loss to lease recapture that we know that we can achieve over a period of time. And there's been a number of, I guess, what you could maybe classify as bad actors in our space over the years. And I'm not saying they're right or wrong, whatever. Everyone's got their own business model, but quite a number of them will go in and just literally recapture that entire loss to lease year one. And again, I'm not going to say that's right or wrong. Everyone's got their own business model, but I think we take a little bit more ethical approach. And we're a resident first company. We're a people first company. Without each one of you in this room, we would cease to exist. Without each one of our residents inside of our communities, we would cease to exist. That all has to kind of work together in unison in order to have a thriving company. And so, typically, while others might underwrite a full loss to lease recapture in year one, we typically draw it out over 3 to 4 years. And that first year might be a little bit bigger of a bump than the remaining 3 years, but we typically like to draw it out and I guess you could say ease the pain a little bit more than a lot of other competitors in our space. Lots of other, and I think to kind of bake that in, or to bake into an additional point here is that a lot of other operators really treat the residents just like a line item, right? Like they're just another number. They don't really, they could care less about about that individual, their family, what their personal circumstances are. They're really just a line item, and they're looking at what does it look like dropping all this to the bottom line, and who cares, who they are, what's going on in their life. Like, we're just treating this as dollar signs. We manage it quite a bit differently. And then, I think that the last piece here is what all that turns into with a lot of our other competitors is a lot of negative media. Lots of, you can do your searches and find lots of other news stories about what others do and really how they're drawing attention to our space, not in a good light, but in the bad light of going in and taking advantage of residents and, pushing rents 100%, maybe even above market, literally right out of the gate, not really injecting capital back into these communities, not making them a better place to live. Our objective is to not only just make money for all of us in this room, right? Like, we wouldn't be in the business if we weren't here to make money. So I'm not going to joke with you and say like, I do have a passion for affordable housing, but look, if this wasn't making money, we wouldn't be here now, right? And so I think we're all in alignment there, but we also know and respect that our residents are a big piece of that pie, right? Like, literally, if we don't treat them like humans, then and with respect, then like, what are we doing, right? Like, it's just not the right way to run a business. So again, we stick to this. Again, that might mean we potentially lose opportunities, but it's okay because I know that there's always another deal around the corner. Let's see here. All right, so a couple of things that we do on the underwriting side that I think, oops, damn, I knew I was going to do that. One of the other areas, when we're looking at deals, again, you look at these broker OMs and their assumptions, and it's like, where'd you guys come up with this crap? You guys have never even operated a property. Like, how are you going to say that someone's going to manage us for 3%? I can promise you that if you're actually running a legit property management operation, you are not making money at 3%. You're not making money at 4%, and you're probably not breaking even at 5%. And so what we've learned over the years is that 6% really is the break-even number for us to actually run these properties efficiently, and know that we've got the right staffing in place, and we're not skimping there. Because ultimately what happens is I see a lot of groups that underwrite, they'll either use their own assumptions or maybe a broker's assumptions, and they'll underwrite deals using a 3 or 4% property management fee. And while that might help them on the front side stretch a little more, pay a little more, what's going to happen is when they go to sell that property, I can promise you that the next buyer in line more than likely is probably going to underwrite to reality and put in there a 5 or 6% property management fee. And so like, it's going to catch up to them in one form or fashion or another. And so they're going to stretch on the front end and they're going to get whacked for it on the back end. 6% is a number that we know works for us. And it's a number that allows us to, we're not very profitable at all on the Sunrise community side. In fact, when we break even, we're very happy. And so 6% helps us get to a break even level and also manage the properties effectively. I've already talked about the annual cap reserves across the entire life of the hold. But another big area here that I think we're quite a bit different, where we take a conservative approach and where we really dive deep is, and this is a big risk in some markets, not many others, but generally speaking, it's still a huge risk, is the tax assessment risk on these mobile home parks. A lot of times we're buying from a mom and pop, a legacy owner that's owned it for 10, 15 years, and more than likely, it's way underassessed. We might be paying $10 million for it, and the assessment might be $1 million. Every county and every state handle these tax reassessments differently, but it's an area that I see a lot of folks get absolutely whacked. They'll go in and they'll do a full price allocation on the purchase contract, and they'll get reassessed 100% to the full valuation in year one, and didn't underwrite that their property taxes were going to go up 5x or even 10x. I mean, I've seen it happen, and so we're very strategic in this regard. We've got a number of consultants that we work with. I mean, we go pretty deep, and this is an area we spend a lot of due diligence and really understanding what that tax reassessment risk is on the front end, and that we understand it, and that it's not going to catch us off guard. And then second to that is, even if we buy something that doesn't get reassessed during our hold period, like I've seen instances where some counties might only reassess every 3 years. We might get in, buy something, and decide that we don't want to, we don't want to hold it for longer than 3 years, and we're going to go sell it to somebody else. Well, guess what? If we didn't underwrite that reassessment, that next buyer more than likely will, right? And so like, we need to know that going in, that we're going to get dinged for it on the sale side, because someone's going to have to pay the piper at some point. So we're always looking at the tax reassessment in a very granular level so that we understand it and that we can actually model it and understand the risk behind it. And then, again, just the last point there, which I just kind of hit on, is that we really want to align with reality. I don't ever want to assume that the next buyer in line is a fool and they're going to miss things. I want to assume that they're going to catch these big risk factors and they're going to underwrite to them. And I don't want to be the one that pays the price when that day comes. So So again, the market dynamics, I've talked about this a little bit. One of the biggest truths, and this is applicable to any asset class, is that you can buy a beautiful-looking mobile home park in a not so great market, one that's got declining population, jobs are moving out of the area, but the park looks great. You might be able to buy it at what is seemingly a great basis, great cap rate. You buy it at 10 cap, and everything else is trading at a 5 cap. But the one thing that you can't change is the market, right? Like if you buy in a inferior market, a poor market that doesn't have a demand for affordable housing, doesn't have the right quality tenant base that you're seeking, doesn't have growth, doesn't have diversity of employment, then you're fighting an uphill battle, one that you're never going to win. And so we're very critical about the market itself. A lot of deals that we decide to pass on are in markets that are too small, markets that don't have a diverse enough employment base, might not have a large enough population, might not be have large enough growth factors of the population, might have too high unemployment rate. Like there's all these factors that we look at, because I know that I could take the ugliest park in the world, but if it's in the middle of Raleigh, North Carolina, pick your fast-growing market, I could take that ugly park, and I know that we can breathe new life into it, even if it's got an undesirable tenant base. I know that if it's in the right location, that I can fix all the other factors. I can go in and put new roads in, put new homes in, add amenities, new street signs, playgrounds. I can do all these things, and I know that I can then attract a high-quality resident base that is in high need of affordable housing in that respective market, because really the market drives the success of a deal. So I can get the bad element out, and I can attract the positive folks. And the other example I gave, I can't attract good people in because there's none in the area, right? And so I don't care how nice the park is, you can't change the market dynamic. Oops, let's see here. So one of the other cool things that I think that we've put forth over the last couple of years is that I would say, well, I think I'm really good at finding great opportunities, and I would say up until 3 years ago, most of all the decisions were made just with Brian and I, actually deciding on. I would show Brian the underwriting, share with him, my investment thesis for the deal and why I felt so strongly about it, and Brian and I would make a decision somewhat, I wouldn't say in a silo, I mean, it's the two of us, but we didn't have a formal investment committee. And you don't find that groups of our size typically have a formal internal investment committee, but this is something that we put in place in the last couple of years, and it's something that has really allowed us to just expand our perspective. We've got some brilliant folks on the team, but garner their insights. Lots of the folks in the team, Todd, he's been part of a multi-billion-dollar organization in the MH space. Mike, the same thing. Sam, our asset manager, same thing. And so we've got these brilliant individuals that can provide their insight and their feedback. They can press us on assumptions. And so we've got a formal investment committee now. Every deal, we present it, myself and my counterpart, Kirk Zandier, he's on the acquisitions team. We basically come and present it to our investment committee, which consists of CFO Mike, asset management Sam, Todd on the operations side, again, acquisitions folks, myself and Kirk, and then Brian as well. He's in the investment committee. And so now the investment decisions aren't made in a silo. We're collectively putting our brain power together. Mike's challenging us on the number assumptions. Todd's challenging us on our CapEx budgets. And what comes out of that is that, while I feel like I've done a great job of buying deals before we've had this in place, it really forces the acquisition side to dig quite a bit deeper even and try to uncover maybe some of the additional uncertainties that we didn't see through our perspective, but ultimately others are seeing through their lenses. So I do think that sets us apart. Again, I'd say most groups in our space, you don't really see a structure like this in place until there are probably a couple $1 billion. And so obviously we're not there, but I'm very proud of the investment community that we put in place, and I think this is going to allow us to continue buying great deals, even in more competitive marketplaces. So just to give you guys a sense of, we look at a lot of deals. And this is just rough numbers. This is based on I looked through last year, how many actual leads came through the pipeline, and a lead could, or a deal could be just a broker OM, just an email from somebody saying, hey, I got this opportunity. Is this something you'd have an interest in? But last year we looked at, I think, roughly about 700 deals that came through our inbox or came across our desk. So, but of every 100 that we actually look at, about 20 to 30 actually, go to underwriting. And what that means is, the 70 that don't, there's something inherently wrong that I pick up right away. Like it's either a not great market, it's too small of a property, maybe it's got some weird infrastructure things going on. Just maybe it's on the wrong side of the tracks, and we just don't feel confident in our ability to do something with it. And so, but there's a lot. That first 70 kind of get flushed out fairly quickly. And then of the ones that pique our interest, we like the basic fundamentals of the deal just at first glance. We'll typically send those to our team of analysts. They'll go through the underwriting process, and they'll put it into a full-blown model. They'll spend a couple hours on it, put it into a full-blown model, and then we'll go in and we'll start tweaking it. We'll start adjusting assumptions, implementing market data that we pull into place, and really kind of, I guess, turning the wrench to see if this thing could actually truly fit our buy box, or if for one reason or another that it's just not a good fit. And so out of those 20 to 30 that go to full underwriting, really there's only about 7 or 8 that we feel like, based on seller expectations, based on the market, based on the deal profile, I would love to, at the right price, I would love to own this. And so those 7 to 8 typically get LOIs written, letter of intent, and then out of that 7 or 8, get one. And so last year we ended up, how many deals did we buy, Brian? Help me think. 10? Yeah. Yeah, so there you go. So underwrote over $1 billion and closed, roughly, $100 million of assets. So anyway, looked at a lot and said no to a lot. And again, some of those that we wrote LOIs on, some of those come back around, and again, we just stay disciplined. Again, that's why we only get one accepted out of 7 or 8. We're never going to be the highest payer. I don't think that there's ever been an instance where we've actually been the highest bidder on a property. Even the ones that we've gotten awarded, they weren't awarded to us because we paid the most. The thing that I'm proud of is that the ones, and what we've done over the years is the ones that do get accepted, they get accepted not because we're the highest payer, but because we've got such a great reputation and track record, especially in times over the last couple of years when other buyers weren't buying, right? There's lots of groups that had a name in the business. They were, they had capital, they were buying. Everyone had capital, but they were buying, and so they were the ones that were thought of through brokers that could get the deals done. And then ultimately, our name has floated to the top of that. And so now we're getting, a lot of the calls from these big brokerages that do the majority of the transactional volume because of our reputation, our track record. Let's see. So just to speak to some of what I see to be some of the biggest deal killers over the last couple of years, and the reasons why we kind of step away from things. Again, I've spoke to this a little bit, but seller price expectations. That's still, oh my God, like there's I think there's still a lot of folks that are still stuck in 2021 era. When rates were 3%, and sometimes you just can't fix that. You can't reset their expectations. At the end of the day, if they hold on long enough, more than likely their expectations will come to fruition, right? But we don't necessarily share the same rosy glasses that they do. And so again, we're disciplined in our approach, and we'll pay what we feel is a good number and whatever their expectations are. And if there's too big of a delta there, we move on. We'll make an offer, but we'll move on. Again, the market demographics that we're looking at here: low median home prices, low median rents, weak income, job diversity. If it's got all those elements or one of those 3 elements, we typically move on, because a lot of what that tells me, at least the low median home prices, the low median rents, that tell me that market might not have a affordable housing problem. There's a number of markets. I know we've got this nationwide problem, but there's still a number of markets that you can affordably live in. I've seen many markets in some Midwestern areas where the median home rents for like a 2 or 3 bedroom is still under $1,000 a month, which is crazy. You can still buy a home for $100,000. And so in those markets, how are we going to sell an affordable housing product when everything else is affordable, right? There's no compelling purpose of our business model in some of those markets, so we steer clear of it. And then some of the other issues that really creep up during due diligence, and I can't think of any recent examples of where this really were deal killers, but even then, infrastructure problems, right? We do sewer scopes, we do water line pressure testing. The things that typically will kill a deal are the things that you can't see, that are under the ground. Above the ground, we can look at rent rolls, we can look at financials, we can piece all that together, we can use our assumptions, so we can really get a clear picture, generally speaking, of what's happening, what's going to happen, and how it's going to happen. What you can't see is what typically will kick your butt and kill you, and that's under the ground: water lines, sewer lines, electrical infrastructure. And a lot of these parks, they were built 50, 60, sometimes 70, 80 years ago, and that stuff doesn't last forever. And so there's been a number of occasions, I guess, Todd, I'm thinking back to that Michigan portfolio maybe 2 years ago, that there was like 4 properties, and every single one of them had a absolute nightmare under the ground happening of different, size and scope. And so for that reason, we passed on it because we knew we could fix it, but it would have been a burden on our resources. It would have been a burden on the team, and it would have pulled us away from the next opportunity that I knew would come sooner or later. Yeah, and Todd has spoken to a few of these, but I mean, just the big risk factors that we see, in the MH space, the licensing regulatory approvals, like that's not that big of a deal. It's still something that we take into consideration. But one of the big ones, like conservative schedules, we're looking, if we're putting a rent increase in place, or we're going to do an infill, or some other, a major bill back of utilities. Typically, we're not even underwriting that until going into the second year. Sometimes we'll do it sooner, but what we really like to do initially is we like to go in and actually breathe some new life into the community, right? Like actually put money back into it, redo the roads, redo any infrastructure, make improvements, build shelters, as Todd showed you, before we put any type of rent increase or build back structure in place. Again, tax assessment, I spoke to that. I don't need to go down that road. Insurance is a big one as well. Insurance, we proactively always get our insurer involved to get a general understanding, not what the existing owner is paying for insurance, not what the broker put in the OM, but like what's insurance really going to cost us, and to get the appropriate coverage and ensure that we're underwriting it accordingly. And then, again, I think there's risk with this is more the structured parking. So we haven't talked about parking, so I'm going to hit on this because I think this is key, and this is an area that I think you guys need to understand about how we look at parking opportunity, because there's a number of similarities, but there's also differences with the two. With parking, we want to buy below what we feel is replacement cost, what it will cost. If you could replicate that product in that marketplace, we want to be able to pick this up for below replacement cost. That's a little more difficult to do in the MH space, but in parking, this is something that we stand on. So all the deals that we bought thus far, you would not be able to rebuild any of those parking facilities for the price that we paid for them. So that gives us that margin of safety going in. Second to that is, more than likely, in most of the areas that we own these parking assets, you would not be able, even if you wanted to, if you had the money to do it and you had the land, you wouldn't be allowed to do it. Municipalities hate parking just like they hate mobile home parks, unfortunately. It's necessary infrastructure, as we all know. But in their minds, just like they think that every mobile home park is drugs, sex, and rock and roll, which it's not, they think every parking is just a big, ugly concrete structure, right? That's unsightly to everybody, and so they don't like it. They don't like new stuff being built. In fact, a lot of cities have actually eliminated the parking minimum requirements for new developments, which is, again, another big boon for us. Let's see here. Yeah, and again, you guys know this, but we can just talk about this. I mean, why we believe in these asset classes for a very long term. I mean, we feel like they're both very durable. Obviously, affordable housing is massive shortage. There's limited new supply. Again, we look for markets that have demand for affordable housing, not just today, but we feel as though it's going to be the case for many decades to come. Structured parking, again, a lot of similarities there. To my point, I was making about a lot of large cities. I think, Brian, was it Denver that most recently removed the parking minimum requirement, I believe? Yeah, Denver, Dallas, Boston, it's on the docket. So all these big cities, there's a number. I think there's like 80 or 90 so far. Big cities across the country have, over the last decade, have removed their parking minimum requirements. And what that means is that, historically, if you were a developer and you're going to go, call it redevelop a surface parking lot, you're going to put a high rise on it, office tower, whatever you're going to build on it. They would typically require that you put in X amount of parking per 1,000 square feet. There was a formula that they would use. It could be a 1.2 parking spaces per 1,000 square feet. It could be 2. Either way, they're going to force you, not because you need it, because your business plan says you need it for whatever you're building above the ground, but because the city says you need it. And so a lot of these cities have removed this parking minimum requirement. And what that means to us is that when developers go in to redevelop a surface lot, guess what they make more money on than putting parking spaces in their garage? They make money on building another condo unit, building another office space, right? Like, they make more money on the actual, the business that they're building, not building excess parking for people that don't need it. And so these developers now are just building the bare minimum, sometimes not even enough parking. For example, next to Lohr's, our parking garage in Phoenix, there was a building that they converted into a hotel recently. It's now to Moxie. Is it a Moxie? Yeah, that's a Moxie hotel, high-end hotel. And there's zero parking. There's zero. They didn't make them put in any parking. They allowed them to convert it to a hotel, and there's zero parking. And guess where they all have to park? In our garage right next door. So it's a beautiful thing. So when we look for parking, we want to buy in what we feel is irreplaceable locations, irreplaceable real estate at below replacement cost, because we know that the parking supply is diminishing day by day, week by week, year by year in all these markets that we're buying in. So it's a necessity. It will continue being a necessity, even when cars are flying or drones are picking us up or whatever's happening in this world. Those things will still need a place to stage in a park. In fact, we're looking at a deal right now in parking that Waymo currently leases like 30 sites in the garage, right? And so just because there's autonomous vehicles, they still need a place to go. Our country doesn't have the infrastructure for these things to be driving around, 24/7. So they have to go somewhere. They have to recharge. They have to have a staging area. So for that reason, we love parking, and we believe in it today. We'll believe in it for many, many decades to come. Again, we underwrite to 10 years or more. Sorry guys. We don't focus on the buy, fix, and flip strategy. Again, crystal ball, it's broken. I don't think that's not the best way to make money, and it's also not a great strategy for the tax benefits associated with real estate. I think Brian had hit on this the other day, is that we can get in and we can do a 1031, but that doesn't solve for the depreciation recapture issue that ultimately occurs. And so we're not really in the buy, fix, and flip model, for that reason, but also the reason that they're not making more parking and they're not making more mobile home parks. So when we buy a great park in a great park or a great parking garage in a great market, we know that it's inherently going to become more difficult to buy that same property again, and so we want to hold it for the long term because we know that it's truly irreplaceable. And again, that aligns. Brian spoke about this, kind of like our legacy and kind of what we're trying to do for our own families and what we're trying to do for your families is we're looking to build something that's durable for a very long term. We're not just in and out of this business quickly. We're looking at it for multiple decades, not just this decade that we're currently in. And then so I'm running out of time here, so I'm long-winded, Brian. Normally that's you, not me. This is one of the deals that we said no to recently. This is probably about a year ago. This was from the outside looking in. In fact, I know if we'd have bought this, we'd have made money. Hands down, we'd have made money. I went to look at it. Todd was with me and one of our other ops guys. We went to look at it together. It's in a very expensive market in Maryland. It was a little unique going in, but I could get over that part. So it was a fractured 350 space mobile home park. And what that means is that originally, and I get tidbits of the story, but what that typically means is that it was probably originally developed as a subdivision many, many years back. And for whatever reason, that subdivision plan didn't play out. Maybe they're just going to, buy and sell homes. They got it converted to a mobile home community. But being that it originally was planned for subdivision, each one of the lots were individually deeded. So it wasn't one parcel ID encompassing the entire property. It was individual parcel IDs for each one of the mobile home lots, each one of the 350 mobile home lots. Well, the guy that owned it when we were looking at it, at some point in time, he bought 180 of these lots. And so they weren't in a row. They were kind of spread out through this community. And so he didn't necessarily have full control over the entire community. But even with that being said, looking on paper, had a massive loss lease recapture. The market, the median home price was $450,000, $500,000. Median rents for over $2,000 for a two-bedroom. I mean, all the bullet points that get us excited. I'm yes. I mean, this is you can't lose here, right? From a numbers point, you can't lose. From a pro forma, you can't lose. But as we arrived at the community, and again, I knew we were driving into a fractured community, but it did prepare me for what we were about to see. And what we saw is that, number one, the entire community was in disarray. There was a homeless encampment happening down in the bank. I mean, it was rough. And we can fix rough. We can fix that challenge. We can infuse capital. We can enforce rules. We can fix that. But we can't fix it on the lots that we don't own. And so where I saw the risk is that, number one, this little town didn't have a code enforcement office. They didn't have it. They didn't have a dedicated person that was enforcing this stuff. So we wouldn't have any alignment with the local community to help put these rules in place and enforce them. So that was the problem. The second problem is that we can make our individual 180 lots look great, but the neighbors on either side, it's a shit show, right? I mean, we can't fix that piece of it. And so I saw it as a problem where it'd be an uphill battle, it'd be an uphill climb. We would make money, but Todd and his team would hate me. They'd be banging their heads against the wall the entire time, and they'd have a very difficult time ever getting full control over that entire community. And so for that reason, we decided to pass. I decided that it was going to be too much of a burden on the operational team, and that because I know there's always another deal coming down the pike. I just do. I didn't know what it was at this point when we were looking at this one, and I hated killing it, but I knew that inevitably it would free up our time, allow us to focus on that next deal when it inevitably came. And surely it came, right? And multiple more deals then after that. But this would have drained their, not entirely, but this would have pulled their bandwidth severely in the wrong direction. Again, we'd have made money, but I think we've made more money by saying no and buying the other deals that came down the pike than saying yes to this one. Someone else bought it. I don't know who. I haven't really followed it, but it's okay. I don't get emotionally attached to this stuff. I kind of just move on and call it a day. So this is a case study where discipline really paid off on our part. This is one of our pride and joys here. This is the Lord's Parking Garage in Phoenix. This is owned in Fund 3. So this one we tried to buy in 2021, and our offer was $28 million at that point. And we were outbid. I think it was just under $2 million that we were outbid by. And we were the second buyer in line. And the owner, who was Invesco, which is one of the largest private equity groups in the country, they owned it, and they decided to go with this other buyer. Whether it's because he paid $1.5 million more, I'm not sure. Probably that's probably what they were looking at. He was a qualified buyer. I think this is July of 2001. So we made the initial offer in 2021, and then in October, November 2020, I get a call from the broker that this buyer, his capital fell apart. I can't believe it hadn't even closed by that point. It was like 4 or 5 months after, and it came back around. And what I found through the grapevine, during doing some additional due diligence, is that Invesco had a debt maturity coming up in March. That put a big smile on my face. And so we went back in and renegotiated. And at that point, as you guys remember, 2022 rates were starting to go back up as we were getting into this deal, and we ended up negotiating it down to 20.4. I believe it was 20.4 million. And then we've got roughly $5 million of seller concessions. Those are not exact numbers, but that's roughly speaking what we acquired it for and negotiated as far as seller concessions. So I guess you could say effectively, we paid $15.5 million when originally, we were willing to pay 28. And honestly, 28, we still would have made money at 28 million, but we make a lot more money by buying it at that kind of a discount. Yeah, this deal, again, this is kind of a pride and joy, and it's hard to replicate this. If you're in this business long enough, what you'll find is you really just go for the great singles and doubles, right? And if you do it long enough, you're going to hit a grand slam or a home run every once in a while, and this just happens to be one of those. And so, again, these will come as time goes on, but this is the beautiful one. I mean, our actual performance since we've owned this property now for roughly 3 years has exceeded our budgeted projections year over year by 33%, which is incredible. Yeah, I'm not going to share what I think the valuation is, but it's significantly higher than that of what we paid. I'll leave it at that. And it cash flows like crazy. And so, just speaking, again, I'm out of time. I know, guys, I'm going to hurry up here. And this is just, really at the end of the day, guys, these are our bedrock principles, our core values, what we live and breathe by. And so we really do, we implement these bedrock principles into every department inside our organization, including acquisition. So, we've got ethical end plans in place. No year one shock to residents, as I had mentioned. We take, a conservative approach to our assumptions and what the capital stack looks like, what the debt load that we're putting on the property. We treat our residents with respect. We're not an a-hole. We're in the people business. I mean, people first and foremost. So we wouldn't be here if we treated it otherwise. And we just try to do the right thing. We treat every dollar as though it's our own because, again, like I said, our families are heavily invested in Sunrise, and we treat our own dollars equally that we treat yours. So I just wanted to kind of wrap this up with just maybe a brief overview. We're always busy on the acquisition side, and so I didn't put any particulars about what we're working on because honestly it changes all the time. We've got this internal dialogue that always happens between us and the marketing team of hey Kevin, what's going on deal-wise? I'm like, I could tell you what's really going on of the conversations I'm having, but I just don't, and you never know what's going to come to fruition. You don't want to set false expectations of what's going to actually make it to closing, what's not even going to get under contract. And so, but just generally speaking, we're looking at a lot of deals. We do have 4, what I feel are very exciting as of today, mobile home parks that are currently in various stages of either verbal offer accepted, accepted LOI, maybe working on red lines on a PSA agreement. We've also got several structure parking opportunities under LOI. We just wrote a LOI literally last night. I had to leave a little early and go up, and we've been negotiating a surface parking lot in Houston. It's an amazing lot. And I believe, I'm pretty confident we're going to get awarded that deal. We were second in line, and I think we got it over the finish line last night. Again, don't hold me to that, but I feel very good about it. And about if you collectively look at all the things that we're looking at or that we're actively pursuing, it's about $100 million. And our 2026 goal is to add at least $100 million of new assets under management. Again, I feel strong conviction that's going to happen. But if it doesn't, what that means is that there just weren't enough deals that really fit our criteria. And again, we look at our capital as patient capital. We're patient buyers, and we know that we're going to be in this business for a very long time. So we're only going to buy the properties that make sense and that we feel absolute certainty around. Yeah, you guys know the track record. I mean, come on, like 33 consecutive quarters on time. You know why? You know why we're all great. We're all here together. We're doing great things together. So I'm not gonna roll through this for the sake of time here. But again, we truly are grateful for your trust and your belief in the organization and us and our team. And again, we wouldn't be here if it wasn't for you. And know that we look at this business not just as like what's going to happen in the next couple of years, but we look at this as a legacy company. That one that our families are proud of, our boys and girls. He's got young children, I got young children that they'll be proud of. That it'll be around when they've got kids and grandkids. And so, I mean, this is really very much a legacy company that we're looking to build, and just really appreciate each and every one of you for taking the ride with us and believing in us and having faith in us. And with that, I'm going to wrap it up here, guys. Again, just reiterating some of the same points. I'm sorry, I'm just going to go through this because I don't like to be redundant, but we treat capital like it's our own. We'll stay disciplined. You're not going to change me. Brian's tried to change me for like the last 10 years, but you're not going to change me. Yeah, he tries to force me to buy things I don't want to buy. My wife gives me crap about it all the time. Another deal. Yeah, it's another deal. Yeah. But we're gonna stay the same. I'm at the age now where like change is difficult for me. I just like to kind of stay in my path, like the old grumpy man, right? Just do the same thing day in, day out if it works, right? But with that, guys, I think that's all I've got there. So I thank you guys for your time. I thank you for showing up here today.